In 1997, two economists won the Nobel Prize for creating a mathematical formula that could supposedly predict the future. Within a year, that same formula nearly destroyed the world economy. The equation promised to eliminate risk from finance itself. Instead, it turned Wall Street into a casino where the house always loses eventually. And here's the twist. The formula is still running the system today. This is the story of how a beautiful piece of mathematics became a weapon of mass financial destruction, how certainty became delusion, and how the smartest people in every room convinced themselves they had conquered randomness itself. The equation has a name: the Black-Scholes-Merton model. To most people, it's meaningless symbols on a page. To traders in the 1970s, it was scripture. It claimed to do something humans had dreamed of for centuries: put a precise price on the future. Specifically, it could tell you exactly what a financial derivative, a bet on whether a stock would rise or fall, should cost at any given moment. Before this formula, pricing derivatives was guesswork mixed with instinct. After it, finance became a science. Or so everyone believed. The breakthrough wasn't just mathematical elegance, it was philosophical audacity. The formula said, we can measure uncertainty, we can bottle chaos, we can make the unknowable known. And for a while, it seemed to work. The story begins in 1973, in the towers of academia, in the trading floors of Chicago. Two economists, Fisher Black and Myron Scholes, published a paper that would reshape global finance. Later, Robert Merton extended their work, building what would become the theoretical foundation of modern risk management. Their insight was deceptively simple. If you know how much a stock bounces around, you can predict the range of its future prices with mathematical precision. The equation itself is compact, beautiful even. It contains variables for stock price, time, interest rates, and something called volatility, the measure of how wildly a stock swings up and down. Plug in those numbers, and out comes a price for an option, the right to buy or sell that stock in the future. It was alchemy turned into algebra. But here's what made it revolutionary. The equation assumed that markets move in predictable, measurable patterns. That risk could be modeled like the motion of molecules in a gas, that the future, while uncertain, follows statistical rules we can master. Think about that. The entire formula rested on the belief that financial markets behave like physics: smooth, continuous, rational. Wall Street fell in love immediately. Within months, traders were using it to price billions of dollars in options. The Chicago Board Options Exchange opened the same year the paper was published. Not a coincidence. Suddenly, derivatives weren't exotic gambles. They were scientific instruments, blessed by mathematics, backed by Nobel Prize winners. The equation gave traders something they'd never had before: the illusion of control. To understand how this formula works, imagine you're standing in a casino. You want to bet on whether a coin will land heads or tails. Easy odds, 50-50. Now imagine the coin is weighted, but you don't know how much. Suddenly, pricing that bet becomes complicated. You need to know the coin's bias, how many times it'll be flipped, what happens if you're wrong. That's what Black-Scholes-Merton does. It prices the bet. Except the coin is a stock, and the bet is an option. And instead of heads or tails, you're wagering on whether Apple or Microsoft will rise or fall by a certain date. The formula looks at how much the stock has jumped around in the past, its volatility, and uses that to predict how much it might jump in the future. Then it calculates what someone should pay today for the right to buy or sell that stock tomorrow. Here's the magic trick buried inside. The equation assumes that extreme events are rare, that markets don't have sudden, catastrophic collapses, that prices move in gentle waves, not violent ruptures. In mathematical terms, it assumes a normal distribution, the famous bell curve. Most days, stock prices wiggle a little. Occasionally, they swing more. Almost never do they plunge off a cliff. But markets aren't bell curves. They're earthquakes. Long periods of calm shattered by sudden apocalyptic breaks. The equation assumed away the very disasters it would later cause. Still, for years, it worked. Traders made fortunes. Banks built entire divisions around derivatives pricing. The formula became so trusted that regulators used it to measure how much risk banks were taking. If Black-Scholes said a portfolio was safe, it was safe. The model had become reality itself. And then slowly, something dangerous happened. The equation stopped being a tool for pricing bets. It became a tool for making bigger bets. If you could measure risk precisely, you could take more of it. If you knew exactly how much a derivative should cost, you could buy thousands, millions of them, leveraging every dollar into a mountain of exposure. The formula, designed to describe the world, started to shape it. In 1994, a hedge fund called Long-Term Capital Management was born. Its founders included Myron Scholes and Robert Merton, two of the men who created the formula. It was a fund built on mathematical certainty, staffed by PhDs and Nobel laureates. They called it picking up nickels in front of a steamroller. The bets were small but made thousands of times over, leveraged 30 to 1, sometimes 100 to 1. The margins were tiny. The scale was unimaginable. For 4 years, LTCM printed money, annual returns above 40%. The smartest minds in finance had cracked the code. They had turned the equation into an engine, and Wall Street watched in awe. Then in the summer of 1998, Russia defaulted on its debt, a distant crisis, seemingly contained. But financial markets don't obey borders. Panic spread. Investors fled risk everywhere, all at once. Volatility exploded. Prices moved in ways the model said were statistically impossible. 10 sigma events, anomalies that should occur once in the lifetime of the universe. Long-term capital management collapsed in weeks. The fund lost $4 billion. But worse, it owed hundreds of billions more. Every major bank on Wall Street was exposed. If LTCM went under, it would drag the entire financial system with it. The Federal Reserve had to intervene, orchestrating a private bailout. The formula that promised to eliminate risk had nearly vaporized the global economy. Myron Scholes later said the model didn't fail. Reality failed to match the model. That sentence is worth rereading. The architects of modern finance blamed the world for not behaving like their equation predicted. Here's the irony that cuts to the bone. Black-Scholes-Merton didn't cause the crash because it was wrong. It caused the crash because everyone believed it was right. When every bank uses the same model, sees the same risks, makes the same bets, the system becomes a monoculture. Fragile. Synchronized. One shock, and the whole structure shudders in unison. The equation assumed that markets were liquid, that you could always sell what you owned. But when everyone tries to sell at once, liquidity vanishes. It assumed that past volatility predicts future volatility. But crisis creates its own volatility, feedback loops spiraling out of control. It assumed that extreme events were rare outliers. But in finance, extreme events aren't bugs. They're features. The greatest trick the formula played was making people forget that models are maps, not territories. A map of New York is useful. But it's not New York. You can't live inside a map. And you can't bet $1 trillion on a map and expect reality to comply. After 1998, you'd think the world learned its lesson. It didn't. The equation survived. it evolved. It became more complex, more sophisticated, wrapped in layers of new mathematics. Banks hired more PhDs, built bigger models, took bigger risks, because the alternative, admitting that the future is unknowable, that risk can't be bottled, was unthinkable. It would mean admitting that trillion-dollar industries were built on sand. By the mid-2000s, Black-Scholes logic had infected every corner of finance. Mortgage bonds, credit default swaps, collateralized debt obligations, all priced using descendants of the original formula. All assuming that risk could be measured, sliced, packaged, and sold. And once again, everyone believed. Until 2008, when the entire system froze. The collapse of Lehman Brothers, the evaporation of Bear Stearns, the bailout of AIG. These weren't random accidents. They were mathematical certainties ignored. The model said housing prices couldn't fall nationwide. The model said defaults would remain rare and uncorrelated. The model said the system was safe. The models were wrong. Not because the math was faulty, but because the assumptions were fantasies. You cannot model human panic. You cannot quantify the moment when trust evaporates. You cannot predict the precise instant when a system built on leverage and belief collapses under its own weight. Yet the equation endures. Today, Black-Scholes-Merton is still taught in every business school, still used by every major bank, still embedded in the software that prices trillions of dollars in derivatives every day. It has become too big to fail itself, not because it works, but because the entire architecture of modern finance is built on top of it. To admit the foundation is cracked would mean questioning everything. So where does that leave us? Standing in the ruins of certainty. The equation promised mastery over randomness. It delivered catastrophe instead. But perhaps the real lesson isn't about mathematics at all. It's about belief, about the human hunger for control in a world that resists control, about the seductive danger of mistaking precision for accuracy. Black-Scholes-Merton is a perfect formula for a world that doesn't exist. A world where markets are rational, where extreme events are rare, where the future unfolds in smooth, predictable curves. We don't live in that world. We live in a world of panics and manias, of cascading failures and sudden ruptures, of humans making emotional decisions with borrowed money. The equation didn't break the economy because it was wrong. It broke the economy because it was believed. Because it gave people permission to ignore doubt, to dismiss warnings, to leverage themselves to the hilt and call it science. The formula became a priesthood. And like all priesthoods, it demanded faith without question. Here's the uncomfortable truth. We still want what Black-Scholes promised. We want the future to be calculable. We want risk to have a number attached. We want to believe that somewhere, in some algorithm, some model, some equation, there's an answer. A way to win without losing. A method to predict without guessing. But the universe doesn't offer that bargain. Markets are made of humans, and humans are not gas molecules. We panic. We herd. We believe stories more than statistics. And when the story everyone believes is, the model says we're safe, that's precisely when we're most at risk. The equation that broke the global economy is still running, still humming quietly inside every trading system, every risk calculation, every derivative price, not because it's right, but because replacing it would mean confronting an unbearable reality, that the future is not a formula. That certainty is an illusion, that the smartest people in the room can be catastrophically wrong. History doesn't repeat, it reveals. And what the Black-Scholes-Merton story reveals is this: the most dangerous thing in the world isn't ignorance, it's the illusion of knowledge. The equation gave us that illusion. We built an empire on it. And when it crumbled, we learned nothing. Because the truth is, we don't want to learn. We want to believe. And that belief, more than any equation, is what breaks economies. Over and over and over again.